Thanks, Chrissy. Good afternoon, ladies and gentlemen. As we stand at the precipice of a transformative era in global energy, it is my honor to address you today at the Future Facing Commodities Conference in Singapore, and a big thank you to the event organizers for inviting Benchmark and myself. My name is Mike Finch, as Chrissy mentioned, Head of Strategic Initiatives, and it's with great enthusiasm that I delve into the pivotal topic of the energy transition and the indispensable role of critical minerals, of course. Now, the world is undergoing a profound shift towards sustainable energy sources, driven by the urgent need to combat climate change and ensure a resilient energy future. This transition, however, is not merely a shift in power sources, it's a comprehensive reimagining of our energy landscape. At its core lies the indispensable role of critical minerals, essential components that power the batteries, fuel cells, renewable energy technologies driving this transition forward. Simply put, or to look at it another way, without mining, there'll be no energy transition. Without collaboration, no energy transition, no recycling, localized refining, no batteries, no accelerated permitting, and also no copper, no energy transition. Now, whilst we won't be discussing copper too much today, no material, in my view, is more critical to the energy transition than copper. Mass electrification is key to energy transition, and vast amounts of copper wire will be required to build out the infrastructure needed for electric vehicles, solar, photovoltaics, and wind. Now, this is all going to need huge amounts of new material, and concerns mounting over whether the new supply can be turned on quick enough to actually meet that demand. For this reason, Benchmark have actually branched out and are beginning to cover the copper markets. We're going to be providing critical supply, demand, and pricing information into that sector, and we're launching a free copper newsletter in Q3 with a view of taking a full-blown copper service or launching that in Q4. So if you're interested, please do let me know. Now, when we talk future-facing commodities, I think of Benchmark. We cover some of the most essential or critical commodities when considering the energy transition. We stand at the forefront of the revolution, providing unparalleled insight and analysis into the critical mineral supply chain. From lithium to cobalt to graphite to rare earth elements to copper, our expertise illuminates the intricate dynamics shaping the global commodities market. We're the world's leading PRA, setting the industry benchmark and reference pricing across lithium, nickel, cobalt, graphite, anodes, and cathodes. We provide detailed supply and demand forecasts alongside cost models in scenario analysis. We have an in-house consultancy team and also a 20-plus strong events team who are actually organizing a free-to-attend seminar in this very building, I think, on Tuesday, the 16th of April. So if anyone's interested, please check the website out. Onto the agenda briefly. I just want to provide a bit of sort of scene-setting information, look at the energy transition, and the associated minerals to that. We've talked a lot about the raw material price weakness, and again, I just want to dive a little bit into there, look at what happened and how benchmarks see this evolving over time. I'm going to focus on some more positive sort of fundamental demand outlook as well, because it is strong and it's growing, and then finish with a little bit of on the investment side, just look at how we're going to plug that gap essentially. So let's look at last year. How well did we transition? I think these numbers were mentioned. Joe brought this up, 13.8 million EVs and plug-in hybrids sold, a fantastic number. We actually surpassed 1 terawatt hour when it comes to batteries produced last year. If we look ahead to the coming year, we're looking at 1.3 terawatt hours of lithium-ion battery demand as well. On the renewable side, China installed 293 gigawatts of solar and wind capacity on their own. That's equivalent to the entirety of the US stock as of January 2023. These numbers are massive, and it's not representative of the doom and gloom that we might have been hearing in some of the sort of news outlets. Let's put some growth rates on that. 30%, 20%, 50%. These numbers are extreme, and I think anyone in any industry would be happy to hear this. So it's not as bad as perhaps people are making out. Now, when we look at the energy transition, we've obviously got the electric vehicles, solar, wind. We've got the platform technologies that enable that, of course. So whether it's lithium-ion batteries, alternative batteries, solar PV, and then we've got a whole suite of critical minerals. These are what is unlocking those platform technologies, feeding into that, and without that, simply, we just wouldn't have any of this. I'm going to cover just 5 of these today. Benchmark cover that whole suite of minerals in some form or another. But focusing in on those 5s, and it's always important to think about the why. Why do we care about the critical minerals? Well, of course, I'm going to frame this in when we're looking just at EV economics. And of course, they're super important, and it drives that. If we look at a NMC 62 sell price back in Jan 2023, at the start of the year there, 70%, that was the equivalent cost of the bill of materials, so the anode plus cathode materials going in made up 70%. On the right-hand side of the chart, we can see benchmarks view for global weighted average sale prices on a dollar per kilowatt hour basis, and that was around $103 per kilowatt hour. We've seen some steep progression there, but let's take a look at what happened as 2023 progressed when we saw the impact of the critical minerals price falls and what happened. So I'm just highlighting what we got here, six odd price series of benchmark tracks, so across lithium, nickel, manganese, cobalt, graphite, natural and synthetic, and of course all of them fell last year. We saw obviously lithium hydroxide has been mentioned before, or carbonate I should say in this case, down 80%. To be fair, it had the furthest sort of to fall. So a weak year if we're just looking at raw material prices. Now what's the impact of that when it comes to looking at sale prices? Well, of course, if we take that same NMC cell, so 62 in Jan 24 this time, it's actually going to make up only 51% of the cost of that cell. The impact, if we were to then look at global average weighted cell costs, our January and February, and I believe even our March assessments, hovering around the $80 per kilowatt hour, which is crazy. I never thought we'd quite get down that low. Good for the consumer. It's made EVs very competitive. There had to be some price cuts to incentivize sort of purchases there, and we're fast approaching parity with ICE vehicles, but it can cause a little bit of pain for people like yourselves. But the important thing to mention is the sky really falling, and I think we've used the word falling a couple of times across yesterday and this morning. This is showing just two examples, as Joe was mentioning. There's many examples of a lithium price, but two here: hydroxide and carbonate CIF Asia. And if you've only been in the industry for 1 year, that's not a pretty picture, is it really? But as we start to unravel more and more history, and we keep going back all the way to Jan 16, let's say you've been in the industry 8 years, it doesn't start to seem so bad when you look at actually where we are at. If we take the 5-year average price prior to that 21 to 23 rally of sort of 1400, we're actually above that, and it's not too bad at all. And Joe was mentioning some different prices, SQMs. Exactly that. It's not actually as bad as perhaps everyone's making out. So to build on that, and then to perhaps start moving into the more positive stuff, we can look at that longer term or mid-term, long-term sentiment and look at some of those fundamentals that underlie that. So if we look at EV sales, set to grow 14% CAGR according to benchmark out to 2040. If we look more holistically at the energy transition, we're looking at maybe 4 to 5 trillion required every year to finance that. Admittedly, that is on a net zero pathway. I'm not suggesting we would get on that pathway, but it's just to give you a flavor of sort of how much is actually required. And of course, why is that important? Because obviously the energy transition is very intensive when it comes to critical minerals. There's no better example than when we look at wind and solar. Now, Benchmark's new analysis, and we have the capabilities in-house now to do this. We're forecasting wind capacity to grow between 7 to 10x. When we look at solar, 13 to 15x out to 2050. So what does that mean? Why is that important? If we just take copper as an example, copper usage in typical fuel sources or energy sources, such as natural gas or coal, it's only about 1 ton per megawatt or 1 kiloton per gigawatt, okay? How much copper actually gets used in that. You take offshore wind, that's 8 to 10x as much copper. If you take solar, it's around 3 to 4x, so far more intensive in critical mineral usage for these clean technologies. And as we've sort of previously mentioned as well, to unlock all of this, we're going to need to see a 4 to 10x increase in supply across different critical minerals, 10x being lithium, 3 or 4 being perhaps more in the region for nickel and cobalt. So to take you on a quick journey then across some of those key critical minerals, I'll look at our sort of supply and demand numbers, or our balance essentially. So on the lithium side, taking our weighted mine supply, so including all those possible and probable projects and weighting that. We stack on top our secondary supply and we overlay our demand base case. And we've seen these numbers in various different forms. Joe this morning mentioned as well, but we are starting to move into deficits as we get out towards the end of the decade there. For nickel, the story is pretty similar. We're going to see actual surplus over the next couple of years, and perhaps a little bit more or a weaker price environment than perhaps, let's say, lithium. But again, we're looking at nickel demand outstripping that of supply, around 7% versus 5%. For cobalt, 8.7% when we take a CAGR for demand versus supply, moving into sharp deficits towards the end of the decade. Now, phosphorus doesn't often get mentioned, but I'm happy to say Benchmark now cover this critical mineral. So if you are interested, let me know. But we're seeing phosphorus demand in batteries to increase 28-fold between 2020 and 2030 as well. One of the things actually skipped over was our outlook for prices. And we think the question is, has the floor been reached? We're very much in agreement with Joe. I think on the lithium side, there or thereabouts, yes, maybe. Some slight increases as we go out for the remainder of the year. Nickel and cobalt, a slightly different story. I think we are at the floor, but I think it might be a bit of a rougher ride for those two, given the excess supply that's in the market currently. Now, to talk copper very quickly, the number I want you to focus on here is that circle and the number in that black circle. That's the share of copper demand that's going into clean technologies. It's around about 20% in 2022. That's set to grow up to 30% towards the end of the decade. And this is a big market, copper, and that's huge growth. A nice stat I always like to pull out is copper is 4 times, or has 4 times more copper in a battery as opposed to lithium on a weight basis. So it's very intensive batteries for copper demand. EV, wind, and solar alone is set to account for approximately 4 million tons of copper demand in 2030, and we're looking at a 9 to 10 million ton increase by 2030 as well. So what does that mean? Looming supply gaps are on the horizon. Yes, substitution can play a role here. Yes, thrifting, I think that's going to be really important when we look at copper usage in EVs. I think that's going to come down a lot more than people expect. And of course, recycling. But is it enough to offset those sort of looming gaps, supply gaps? No, it's not. What do we need? We need more investment, and we need it now. So another way to look at this is some work the benchmark did at the end of last year. And this is just looking at what would, on a capex basis, be required to actually plug that gap. We've come up with a number, 582 billion, huge number. We split it between upstream, batteries, and downstream. I think an easier way or a better way to look at this is actually what's been committed versus uncommitted, okay? So in the yellow, we've got committed capex, and in the black, uncommitted. And we can clearly see here, and we kind of split that midstream, downstream versus upstream. Of the 200 billion that's left to be outstanding, yet to be committed, that's actually 75% is on the upstream side. So lithium, nickel, cobalt, graphite, copper, aluminium, even if we want to include that. So that's where the investment needs to go, especially given the mine lag times that we've talked about. So 15 years on average can range from maybe 10 in China. It can go up to 20 easily. So that's where the investment needs to go, and it needs to go now. Another good way to look at this, and we like this graphic at Benchmark, I think it's very visual and good just to have a quick snapshot. But looking across lithium, cobalt, and nickel, if we were to take sort of the average capex required to build a mine, we look at the average size of said mine, it's pretty simple for us to work out how many mines or additional mines are needed out to 2030 to actually make this all happen. So we're looking at 74 additional mines in lithium, 62 for cobalt, another 72 for nickel, and then additional if we were to factor in lithium metal solid-state batteries also. So the important take-home message that I want to leave everyone with today is the fact that the faster we accept new supply won't come at a lower cost, the faster we will unlock that much-needed capital. I think high incentive pricing is needed to ensure diversified and sustainable supply, and new supplies will have to come from a high-cost source of production. Those marginal producers, facilities that perhaps aren't that attractive initially, that's where we need to unlock, and they're going to be the ones that will carry us forward as well. So to conclude, nicely on time, 2023, yes, we did see a lot of raw material price weakness. We believe a floor has been reached, by and large, across different commodity areas, and we're going to see them either move sideways, be range-bound for a while, or start to improve throughout the course of this year. The outlook for major demand drivers remains very strong. It's never really changed. I think those growth rates, they undershot crazy expectations, but they're still very, very healthy. Significant investment in capex is required to help stem that supply gap, which is forecast to grow significantly between that 2030-2040 period. And high long-term incentive pricing is required in order to do this. Now, one thing that I didn't really mention in my PowerPoint presentation here, but it's really important, is the fact that we expect recent trends of onshoring and friendshoring, integration also, if we're looking at vertical integration at OEMs, that will persist deep into the decade as the need for supply security and a drive to sustainable supply will dominate. And that's me. Thank you very much, Chrissy. Thank you.